Hi, good afternoon. My name is Sherry. This is MassRealty. We're doing Real Estate 101, and we're meeting with Antoine Doan, who is a mortgage broker with Bank of England today. We are going to ask him a few questions about the mortgage process. Hi, Antoine. How are you?
Hey guys. Hey Roberto. Hey Sherry. I'm doing great today. Thanks for inviting me.
Oh, you're welcome. Can you please tell us about yourself, a little bit about your background, where you're from, and where you're living right now? Where's your office located at?
Awesome. Yeah, I've been a mortgage lender for 20 years, coming up to 21 years. I am currently running a mortgage branch for Bank of England out of Braintree, Massachusetts, which is about maybe 10 miles outside of Boston. And we provide lending services to first, second time home buyers, as well as investors who look to buy and invest in real estate.
Great. So how is the mortgage business going on right now?
It's actually been crazy, as you can tell. I mean, the market has been going really strong for a long, long time since, I don't know, 2000, the 2010, 11, 12, since the crash. And every year we've been thinking that, something's going to happen, but it hasn't. So, the real estate market in Boston and Greater Boston has been really tight. There's not a whole lot of supply. A lot of home buyers looking for homes, but there's just not a lot of homes. The great thing is that the interest rate is still so low. So it's still an ideal market for a first or second time home buyer who's looking to buy their first home or to upgrade to a bigger home. So.
So I'm going to ask you a few questions. So the first question is, what is a pre-approval?
A pre-approval is pretty much a letter from a lender indicating the type of a loan or an amount that you would qualify for as a borrower. The pre-approval letter is issued after the lender has had a chance to review all of your documents that you submitted to the lender, such as your credit, your income documents, your asset documents such as a bank statement, and a number of other documents like employment and income. So those are the documents that the lender would review in order to issue a pre-approval.
Do I need to get multiple pre-approvals?
Generally, it's a good idea if you have the time to get maybe at least 2 or 3 different pre-approvals. However, in my experience with most of my clients, time is a factor because, the process of getting a pre-approval can be pretty involved. You have to, work with the lenders to provide them with a lot of those documents. And then it takes time for the lender to actually calculate and review documents to come up with a pre-approval. It's recommended you get maybe at least 1 or 2, or maybe even 3. However, if you've been referred to, a lender that somebody and trust, have done business with them before, then you may or may not even have to, especially if that lender is a broker who has the ability to be able to, access different type of lenders and programs out there. So that lender would end up becoming a one-stop shop for you, where they'll shop different lenders and different programs for you instead of you having to go to different individual lenders. Okay. And Bank of England is one such lender. We actually both a bank and a mortgage company. And as a bank, we have our own in-house programs. And as a mortgage company, we actually have access to other wholesale lenders such as Wells Fargo, Chase, Freedom Mortgage. So pretty much all the mortgage programs that are available out there in the marketplace, we have access to. So we would become a one-stop shop for most of our clients.
Yeah, that's great. So then, people would go to you or go to their, local banks as well, right? So
absolutely, yeah. I mean, and my advice for a home buyer when they want to obtain a pre-approval is really to, number one, stay local. Okay. If you stay local, that means that you get to work with somebody who knows the local areas and local cities and towns and the local programs well enough in order to put them into the best program. Number two, working with a local lender means that you can, if you want to drive to their office and say, hey, how come you don't answer my question or my email? You can. And because of that, most local lenders, would be more willing to actually be on top of the communication with you, as opposed to working with an online lender where you probably have heard a lot of horror stories where, because it's just really, you only know somebody through their voice, on a phone call. And other than that, if you want to see who they are, if there's some problems with the loan process, you really have no recourse. You can't really drive to that lender's office and say, hey, what's going on? What can we do to expedite? So I tend to, recommend that my clients stay with a local lender that they know, that somebody else they know and trust, have worked with before.
Mm-hmm. All right, thank you. So what is a credit score, a good credit score, that you would recommend people having in order to get a mortgage?
So a credit score is basically a number that's based on the information on your credit report. Most credit scores range from around 300 to about 850. And where your score falls in this range represents the perceived risk that you are as a borrower to the bank. Okay, so the higher the credit score, the better you are qualified as a borrower in a sense. Okay, because in the lender's point of view, the higher your credit, the less risky you are as a borrower. So typically speaking, you would want to have at least 680, 700, ideally 740 score or higher. Okay, because once you're at 740 score or higher, you actually would get the best rate possible.
So what is the highest credit score that someone can get? Like 800?
Well, probably around 850. Okay, I mean, in my 20 years of doing this, I've probably come across maybe a handful of clients that have really, really high score above 800. Well, is it necessary to have 800 score? No. I mean, as long as you have like 740 and up, really you're getting the same rate as somebody with 850 score. Okay, so I mean, it takes a lot of different factors to get above 800. But I guess that most of us, and most people are way too busy to really be paying attention to trying to get exactly 800 or 850. So as long as you have 740 and above, then you're really in good shape.
I think my dad has 800. He's old. He's 80, so I guess it's I guess,
I
right?
believe it.
Maybe like does checking your credit score affect your credit score?
Yes and no. Okay, so typically speaking, in my experience, the factors that affect your credit scores the most, especially adversely and negatively, would be if you were to, become late on a payment, right? Your credit card payment, a student loan, your car loan payment. That would affect your scores negatively the most. Okay. Or if you go out there and decide to, open up maybe 2-3 credit cards at the same time, or maybe go and check credit with, a bunch of credit cards, trying to, apply for new credit cards, those credit hits will most likely bring your scores down by, some points. But when you are in the process of getting pre-approved, the way that I understand it is that if your credit scores, your credit is being pulled by mortgage lenders, okay, then the algorithm will allow for the credit bureaus to look at that and say, well, this is actually a mortgage lender pull credit report. So it probably does not affect your credit at all or very little. So I would not be worried about that. Typically speaking, it's advised that if you are in the process of, shopping for a mortgage or getting pre-approved, try to pull your credit reports within a window of about 30 days to basically minimize your credit fluctuation.
Oh, that's good to know. I gotta check my credit score now too. So let's talk about like down payment. What is a good down payment and like what is like sometimes I've heard about like PMI. What's PMI?
Well, basically, down payments are the amount of down payment money that you as a borrower and a buyer are required to put down in order to borrow a mortgage to buy a home. Okay, so typically speaking, with most, if you buy your home to occupy it as a primary home, most oftentimes you can put down as little as between 3% to 5% for down payment and still be able to, finance your home and get into your home. Now, PMI stands for private mortgage insurance. And basically what it is that if you are buying a home with less than 20% down, then oftentimes you are required to pay private mortgage insurance. And that is a way for a lender to transfer the risk of lending you the money with less than 20% down. So what it does, with private mortgage insurance does, is that in the case that you, the homeowner, defaults on a loan at some point in the future, that private mortgage insurance that you pay for will compensate the lender for your loan default.
All right, that's good to know. Can you tell us about like the different types of like loans out there, like the fixed rate loans, the adjustable rate loans, and interest rate loans? And
sure, yeah, absolutely. I mean, there are several types of loans out there that you as a borrower and as a buyer can look into. The most common, probably the most common type of mortgage loan would be a conventional mortgage, which is a home loan that is not insured by the government, by the federal government. And it can be used to finance your primary home or your vacation home or even your investment property. And you can put down, using a conventional mortgage, you can put down, as little as 3 to 5% down if you're buying a home to occupy, and then maybe up to about 20% down for an investment property. So that's the first and probably one of the most common type of mortgages. The next common type of mortgage that I see a lot, especially for first-time home buyer, would be a government issue type of a mortgage. For example, an FHA mortgage, a VA mortgage, or a USDA mortgage. Okay, an FHA loan is basically a government insured loan. It's insured by the FHA, Federal Housing Administration, and that program makes home ownership possible for borrowers who don't necessarily have a large down payment saved up or a great credit. Okay, so it's a great program for those of us who are buying a home who may not have, had a chance to, saved up a whole lot of down payment. So usually FHA loans would start with about 3.5% down. Okay, with a conventional mortgage, for example, generally most lenders would probably require anywhere between, 620, 640, or even 680 FICO score, okay, depending on, the program and the times. FHA mortgage generally requires a lower FICO score. So even if you haven't had a chance to maybe, fix your credit and make it nice and neat, with a higher score, the FHA program may still be able to get you into home ownership. So that's why a lot of first-time home buyers go with a government-backed FHA program because of that reason. Another type of government-insured mortgage program would be the VA program. And this program is for members of the U.S. military. So if you are in active duty or you are a veteran, you and your family would be qualified to go with a VA mortgage program. And one of the nicest features about this program would be that, number one, you may qualify to buy a home with 0% down. And number two, you may be able to, actually, if you qualify for it, then you actually don't have to pay for mortgage insurance even without. So that's my assistant for the day.
Oh yeah.
Jake. So with a VA loan, if you qualify for that VA mortgage, you will not have to pay private mortgage insurance, so which is one of the nicest features of the VA mortgage.
That's good to know. All right, so the question is, what are the costs to get the mortgage? Like, can you talk about the loan estimate, credit report, the good credit report appraisals and costs?
Absolutely. So, once you're ready to, take your first step toward home ownership and getting, looking at homes and getting a pre-approval, one of the things that you definitely should be looking into, and any lender that that are doing the process the right way, should be able to give you a rundown of what you need to prepare in terms of funds to close. Okay. So when you buy a home, some of the things that you have to consider would be, number one is a down payment amount, right? So you got to figure out, based on what loan program you're going to end up going with, what the down payment amount it is that you're going to have to come up with. Beyond that, then you would want to know, in addition to down payment amount, how much money you would need to prepare for the closing cost and the escrow and the prepaid. Okay, so those are the few items that you have to prepare for beyond the down payment amount. So typically speaking, when you start the loan process, it actually takes a lot of different third parties to be involved in the process to get your loan done. Okay, for example, the lender. Okay, the lender has to process the loans, have to underwrite the loans. So with that, there's cost associated. And then there are third-party companies such as the appraisal company that would have to go and inspect the home that you're trying to buy to make sure that that home that you have agreed to buy is worth the purchase price that you agreed to. Okay, a credit report has to be pulled to make sure that you qualify with that program based on your credit report. The lender would also have to do a flood certification to check to make sure if there is flood where you're buying, or there isn't. Okay, then on top of that, you would have a bank attorney, a closing attorney, who represents the bank that you either hire or the bank will hire to basically do work behind the scenes to check to make sure that the home that you're buying, that the title is clear, that they're gonna record the deed. They're gonna check with the city to see if the home owes any back taxes, and they're gonna confirm to see what the monthly or the annual tax amount would be for the property. So there's a lot of third-party companies and individuals that would be involved in the process. So typically speaking, you probably be looking at anywhere between 1%, okay, to 4% of the loan amount that you are trying to secure from the bank to be the closing costs. So on the part of the lender, you have processing fee and underwriting fee. Okay, that goes anywhere between, I'd say, $800 to $1,500 depending on the particular lender. Okay, appraisal fees goes for anywhere between $400 to $800, really depending on the type of property. Are you buying a condo? Are you buying a single family home? Are you buying a multifamily home? Because the bigger the property, usually the higher the cost for the appraisal fee. Okay, so in short, there's a lot of fees that goes into it, but it's fairly safe to assume that you're gonna be paying between about 1% to 4% of the loan amount. Okay, now 1% to 4% is a pretty big range. Okay, so like if I'm buying something for 400,000, does it mean I have to pay 16,000 for closing costs? Not necessarily. It's hard to really pin down the closing costs, okay, without having specific numbers, and that's why I'm giving you a percentage. But if I have to kind of give you a better idea, I'll put it this way. Closing costs are made up of fixed, flat fees, and then fees that change depending on certain factors. Okay, so for example, fixed fees Flat fees would be, let's say, processing fee, underwriting fee. It won't change whether you borrow $100 or you borrow, $1 million. The processing fee and the underwriting fee wouldn't change. Okay, attorney fee, for example, it wouldn't change either whether you're borrowing, $200,000 or $500,000. So most of the closing costs on a loan estimate, they are flat fees, which means that they are fixed. So typically speaking, on a typical 300,000 loan to 350,000 loan, okay, I would say that a reasonable closing cost estimate would be probably around between 3,000 to 4,500. Okay, but that depends on many different factors if you have to put it down.
So how long does it take to close on a mortgage?
A typical mortgage process would take anywhere between 4 to 6 weeks. Okay, so typically Bank of England Mortgage, our branch here for purchase, probably would take maybe about 4 to 5 weeks to get it done. Okay, what takes the most time probably right now is the appraisal process, because there are so many loans being done right now, especially with home refinances, because interest rates are so low that appraisal companies are so busy and they're so behind that as opposed to before, when they weren't as busy, it typically took about maybe between 1 week to 10 days from beginning to end, from ordering the appraisal to getting the appraisal report back. But now it could take up to 3 weeks in order to order the appraisal and then receive the appraisal report back. So that's one of the the items that takes the most time. So if you're in the process of buying a home and you found something that you really like, and then you got under contract for a home, I would typically advise my clients to try to get at least between about 5 to 6 weeks in order to go to the closing, so that they have enough time for the lender to perform all their due diligence.
Right, that sounds good. So we want to thank you for your time, Antoine, for joining us today. It's very, very informative session for us. I hope like all the buyers would get all this information will be very helpful. So okay.
Well, my pleasure, guys, and certainly Roberto.
Yeah, so you have any last advice for somebody who has no idea about anything and wants to buy a house?
My advice is that if you're watching this video, then congratulations. You'll probably have started to to take the first step down the home buying journey. So I think that with buying a home, it definitely takes a lot of time, takes a lot of energy, sometimes a lot of frustration as well. So if you want to save yourself a lot of frustration, my advice is really to talk to Sherry first. Sherry would be able to give you a breakdown of the different steps that you need to look into first as a big picture, and then talk to myself or your local mortgage lender. Because if you tap into the knowledge of somebody who's local and professional, they'll be able to help you navigate the process and maybe take some shortcuts where you don't have to make mistakes. Okay, but other than that, it's definitely a very fun process. So enjoy. Definitely start early. Get pre-approved well before you start looking for a home, because a lot of my clients who did it the other way, where they start looking at homes first without having a pre-approval, go through a pretty frustrating time, because you might end up seeing something you really love, and then you say, oh, I don't have a pre-approval, so I can't really see the home. Or if you could see the home and then they say you have 24 or 48 hours to make an offer, and then you don't have a pre-approval yet, you can stand to lose a home that you really love. So I would say, prepare way in advance, talk to Sherry so that she can basically, walk you through the process and get you into the home that you want.
Yep. Antoine and I, we worked many years together. So, we haven't made the riches yet, but, we're making a paycheck though. That's it. But we're going to make it one of these days.
A day at a time.
I know, one day at a time, definitely. So,